So housing affordability is the best that it's been in 3 years, according to a recent report from RBC. But it's still not nearly affordable enough for buyers to jump back into the market. A lot of buyers are waiting for affordability to improve, not because they're trying to time the market, but simply because people buy houses when they can afford to. And the average buyer in the biggest markets in Canada can't afford to buy right now. RBC also stated that most of the improvement in affordability is already behind us. And I'm going to get to why they said that and why I don't necessarily agree with them. They mentioned specifically that further improvement is on the way, but affordability will remain a huge issue, preventing buyers from re-entering the market. RBC recently interviewed with Global News and the Financial Post, and the headline resulted in a discussion that stated Canadians looking for more interest rate relief might be out of luck. Now, RBC's forecast actually originally went against the forecast of a lot of the other big six banks in Canada. But since then, we've seen headlines come out that more economists think the Bank of Canada is done cutting interest rates. And Scotiabank's Derek Holt is now saying shouldn't even be thinking about when to cut rates. The big reason is because economists are split on what inflation numbers mean for the Bank of Canada rate cut. So let's actually just take a step back here and think about what affordability is composed of. When you see banks do analysis on housing affordability, they use something called mortgage payment as a percentage of household income. So it takes the average household income and the average mortgage payment in that market, and it derives the metric based on those. And so housing affordability isn't purely a house price thing. It's based on house prices, it's based on incomes, and it's based on interest rates, because interest rates are what moves that mortgage payment up and down just as much as house prices, and incomes are the denominator. So we're taking the mortgage payment as a percentage of household income. Now, that mortgage payment as a percentage of household income in markets like Vancouver and Toronto is 92.7%. So you would need almost 100% of your income as an average wage earner to buy the average house in the city of Vancouver. In Toronto, that number is almost 70%. Now, in RBC's analysis, they use this chart that shows ownership costs as a percentage of median household income. And you can go back to previous market cycles like the 1990s to analyze what that looks like at a national level. National Bank puts out another really good report on Housing Affordability Monitor, and their chart goes back quite a bit further. And so I'm going to take a look at that one because I think that there's an important lesson here to be learned. So if we look at Canada's perspective on housing affordability, you can see there's this double peak forming in today's market, where the first peak is when house prices run up and central banks are rushing to get ahead of this inflation. It's not just house price inflation, but usually house price inflation is a result of loose monetary policy or debt that's too cheap. And most goods go up. They would follow a very same pattern of that chart. And then when the central bank cuts rates, where you can see this first peak here, prices drop pretty quickly. And that happened in the GTA especially, and in the lower mainland, so in Vancouver and Toronto. It didn't happen so much in Montreal and Calgary. If you go back to previous cycle peaks, you can see the exact same pattern. You can see the first peak when house prices ran up a little bit too high, a little bit too fast, and then interest rates were hiked in response to the inflationary environment, not just in house prices, but in most goods. The second peak comes from, so you see that quick drop in house prices, and then the second peak actually comes from interest rates rising too high, actually doing their job and making housing unaffordable. And that second peak of unaffordability, where you can see in present day, housing became as unaffordable as it was at the peak house price, even though prices had come down 10 to 15%. And you can see what that big drop in house prices looks like on the Canadian Real Estate Association stats here. And there was a little bit of a bump up after the market kind of stabilized. You'll usually see this bull trap, as it's called, before prices typically will grind down. After you come off this second peak, you have house prices that are falling and interest rates that are falling. And so we have this rate cutting cycle. The higher rates did their job of causing demand destruction in most sectors in the Canadian economy, and inflation gets under control. And then you see the price of most goods fall. Or at the very least, it will experience disinflation, which means that the rate at which the prices are going up is slowing. If you go back to the 1990s or 1980s example, after that double peak, you saw the gray bar here, the gray shading in the background, is a recession. And the recession usually comes after rate cuts have started. Historically, rates are being cut heading into a recession in response to those recessionary signals, and the central bank actually trying to create and stimulate a little bit more activity by getting rates down and increasing consumer spending. Canada has a little bit of a challenge here in such that even if our rates come down, we have the highest household indebtedness in the world. And so people can't really spend or borrow their way out of this indebtedness like they could when rates were lower than when they originally borrowed. This is how credit cycles work. So if you took a mortgage in 15 and it was up for renewal in 2020 or 2021, you would be borrowing at a lower rate. And so that would enable you to actually take on more debt. But now we are at the end of this 5-year period when people were taking mortgages at 2020 or 2021 rates, when rates, the overnight rate was 0.25, you could get mortgages for, the 1% to 2% range. And so nobody can actually borrow more than they could before unless their wages went up. And that brings me to the third part of this Venn diagram here, where housing affordability is a function of house prices, which have come down, interest rates, which have come down, and incomes, which have gone up. And that became one of the policy objectives to get inflation under control. Was this, about this time last year, Tiff Macklem said that the Bank of Canada was looking for wage growth to slow further. And the big reason for this is because they wanted to avoid something called a wage price spiral. And that's when basically if wages are rising, then people have more money to spend on goods. And so when they have more money to spend on goods, the price of goods can go up. There's more capital chasing the same amount of goods. And so prices will rise in response to wages rising, and that becomes inflationary. This wage price spiral is an inflationary problem. Once prices get higher, then workers actually start to demand more money because life's becoming less and less affordable. So they say to their employer, hey, I need more money to be able to deal with this inflation. So can you pay me more money? And that's how it becomes a spiral, and it can very easily spiral out of control. And so central banks want to get ahead of this. Now, let's go back to the original analysis from RBC. Why does this matter for house prices? The problem becomes that house prices have come down, interest rates have come down, and wages are no longer going up. If wages are no longer going up, then interest rates or house prices will need to do most of the work to improve housing affordability, because the Federal Reserve is not expected to cut at their July meeting. There's an 80% chance that they'll hold the existing rate. And even if you fast forward to their next meeting, the largest chance is that they'll cut by 25 basis points and eventually cut by another 25 basis points in the October meeting. And that's what the market is currently signaling. The Bank of Canada really can't get too far ahead of the Federal Reserve because we buy most of our goods in USD. And so if we get too far ahead of the Federal Reserve and the Canadian dollar gets devalued, then the cost of our goods that we're importing goes up relative to our currency. And that's the currency that we make our money in, which would be inflationary or imported inflation for Canadians. Now, wage growth is edging higher based on last month's reading, but it's kind of volatile, and generally with unemployment rising and job vacancies disappearing, relying on wage growth heading into a recessionary environment is probably not going to deliver the housing affordability improvements that we need. So we've got interest rates. Our interest rates portion of the housing affordability Venn diagram here is off the table. Our incomes portion of the Venn diagram is probably off the table or potentially off the table. This means that the only lever in this housing affordability equation is house prices. If wage growth isn't going up and rates aren't going down, then the only thing left in the equation to change is house prices if we want housing affordability to improve. The market wants cheaper houses so that people can buy houses. People want more housing affordability. It's good for the economy. It gives them more disposable income on top of their mortgage payments that they can spend on goods and services and growing their businesses, etc. There's so many benefits to having a more affordable housing market, including for the real estate profession, where realtors make more money if people are buying more houses. And that's why I've never really understood why realtors like to cheer on house price growth so much. So if we jump to RBC's forecast here, it kind of tracks based on their assumptions that wage growth is going to stagnate and rates are not going to come down. Now, I do think that there is sort of the what if scenario, which is if the US economy begins to suffer as a result of the trade war that they have going on globally, and the Federal Reserve in the US starts to cut rates sooner, and then the Bank of Canada has a little bit more room to cut rates. Basically, because of the trade war, the US dollar's fallen significantly since that period of time when the Canadian dollar was doing very poorly. When we first started our rate cutting cycle and we got too far ahead of the Federal Reserve, Canadian dollar got smoked. And since then, the trade war has lowered demand for USD. And so that's actually given us back a lot of strength in the Canadian dollar relative to the USD. But we can't really rest on our laurels with that as a central bank, because if things stabilize and demand for USD goes up, then we're in a bad position if we're too far ahead of them. And we would get that imported inflation scenario I was talking about. So given all of these variables, I don't think that there's a really reliable bull case for house prices for the next 2 years in Canada, simply because wages are not going to give us housing affordability improvements and interest rate cuts are not going to give us housing affordability improvements. And so house prices are going to have to deliver those improvements in affordability if we want more transactions to take place, more construction to take place. Could this change? Absolutely. What could change? Like I mentioned, if the trade war becomes a recessionary thing in the US, and by the end of the year, we're seeing a lot of cuts from the Federal Reserve, we're seeing this standoff right now between Jerome Powell and Donald Trump. Should that become a recessionary threat, the US rates will come down. That gives Canada more room to cut. But based on the circumstances that we have right now in front of us, it is unlikely that we'll see rate cuts being the driving factor in improving housing affordability. So as a result, either wages need to grow, which it seems pretty unlikely from my perspective, or house prices need to come down. And this is why I think that if you go back to previous cycles, what happens after this peak is you will see a big, steep drop. And RBC is forecasting that they expect that drop to not take place. But you can see a pretty historic, reliable channel where people can afford to transact and where you see housing affordability in that kind of 30 to 45% of median household income range. That's where house prices want to stay for affordability. And I would even say that's probably too unaffordable, period, because CMHC's standard for affordable housing is 30% of household income. And if you're just thinking about your own personal budgeting, you don't really want to spend more than 30% of your household income on a house. But in that historic channel, which is that 30 to 45% range on RBC's reading, and that kind of 30 to 50% reading on National Bank's mortgage payment as a percentage of household income metric, I really think that if Canada's economy wants to grow, we need to get housing affordability under control and we need to see prices get back into that channel. And I fully believe that that is what is going to take place over the next 2 years in Canada's market. And it's going to come from a combination of these three factors. I think you'll see house prices grind down a little bit further from where they are now. I think we'll see interest rates eventually grind down a little bit further from where they are right now. And I think eventually, as the economy starts to recover, probably after a couple of years, we'll start to see income growth rise a little bit faster than it is right now. That's how you get back to a historically average and healthy housing affordability and real estate market. And that is what, as members of the market, as potential buyers and potential sellers, that is what we should all be hoping for as an outcome for policy and for economics in Canada for the next 2 years.